Hi guys, welcome back to ValeTalks by Valetax. My name is Innocent Ryan Ifere, aka Ryan for a reason. And today, and as always, I am your host for ValeTalks, and I have with me two amazing guests, Kaza and Manesh. And today we're going to be discussing and also viewing the charts on certain things when it comes to the market. This week, promises to give you a different, exciting topic, like we always do. Every new week is an exciting topic for you to engage with. And this week, we're going to be talking and looking at market volatility. That is the case for this week. We're looking at market volatility, how to navigate your way around volatile markets and maximizing the ability to have a steady growth. Today, my guest with me, like I previously introduced them, Manesh Patel and Shifu Kaza. Thank you so much, guys, for joining me on another episode of ValeTalks. And good afternoon, good morning, good night, good evening to our viewers from around the world, because I believe we have tons of viewers watching from every part of the world. I want to introduce Manesh to us, who is a global market strategist and an educator, an engineer at the CMT and CFTE trader with over 25 years of experience in trading. He has worked with institutional firms developing the black box systems and is the author of Trading with Ichimoku Clouds. And as also, we have Shifu Kaza, who is the global head of education at our prestigious broker, Valetax, with over 11 years of experience and the author of Navigating the Economic World. He holds not just a degree, but also a doctorate with a major in economics and providing structured and academically grounded guidance for traders globally. Thank you so much for being on this live, Kaza, and thank you so much, Manesh. And I would be your host for today, Ryan, a senior market analyst for Africa at Valetax, and I usually love to say I help traders escape confusion with clarity through psychology and market sentiment. And I have over 6 years of experience in the market and the founder of the Ryan FX Swing Trading Academy. Thank you guys for joining in. If this is your first time on this live, wherever you're watching from, be it Facebook, YouTube, our Zoom platforms, don't forget if you're on YouTube to hit the like button, subscribe as well to get engaged and turn on post notifications so you're alerted every time we go live on our YouTube platform for Valetax. And also don't forget to like, follow the Facebook page as well, and continue to enjoy ValeTalks. And don't forget to invite your friends as well. Today's episode, we're going to be going through three major things. We really want to understand what the reality of volatility is, and we want to understand why most traders struggle. And lastly, we want to understand how steady growth can be achieved. And we also have a little token for our new traders online and people who are just joining for the first time about how they can go about the year and the things that they can implement to make the year even better for them as traders. Starting out, this is going to be the open and one of the most interesting parts of today's conversation. Okay, what really is the reality of volatility? Personally, myself, I've been able to put out something on the view that you can see right now on the PowerPoint. And I said volatility is not the enemy. Volatility is a feature of the market. It creates opportunities and danger. Most losses happen when traders rush volatility, and most especially, fast markets punish emotional traders. But today, this is going to be the headline of our discussion. Thank you, Kaza. Thank you, Manesh. What really is volatility? Do we think a lot of traders are getting the idea of volatility wrong or the concept of volatility wrong? Or what exactly is the problem that a lot of traders face when it comes to volatility? Today, I'm not going to be doing the whole one person take, a certain amount of time to talk. I want us to have like a full-blown conversation. And I think we're just going to be able to know when to chip in and when to step out. But it should just take us like a couple of minutes to actually talk about this in-depthly. And for those of us watching at home, for those connected on YouTube and Facebook, please feel free to always leave your questions in the chat. Feel free to leave your comments and questions and whatever you want to say so that we can also go through them and have conversations about them while we're at it. So who's opening the floor for us today?
As usual,
Hassan, you want to or me?
let give the the opening to Mr. Manesh. Please.
Oh,
Oh, thank you. Um, volatility is a big word. It means a lot of different things to a lot of people.
yeah,
Um, and it's a buzzword now that's come out in the last couple of years. But volatility's been around for years. In fact, you can't get to your profit target unless you have some type of volatility. The difference between now and before is that you could have extreme volatility. So volatility's been there, but now it's actually gotten bigger and bigger and bigger, um, and so forth there to a point sometimes it scares people. But
yeah,
you do have to have volatility when you enter a trade, otherwise you're never going to get to your profit target at all. And think about this. The longer you're in the market, the more someone could take your money and price could reverse. So in order for you to not be in the market that long and get your profit target fast, you have to have some volatility there to make the instrument move in your direction in order for you to make money. And that's the
yeah,
key is people have to know that volatility is always being there and you got to make volatility your friend instead of your enemy in order for you to get to your profit target in a short amount of time.
yeah. So when we talk about volatility as the reason why, people is one of the reasons that what moves the market is the reason why people are able to get to their profit target on time. A lot of misconceptions, would we call them misconceptions? Yeah. Or should we just say it's like another perspective of what volatility really is? Because people be talking about how volatile markets are only like when there's chaos in the market, when there are a lot of uncertainty, that's when they start to see a lot of volatility, or there is some sort of fundamentals backing the movement of the market. That is kind of the idea people have about volatility. So, Kaza, would you say that's like a different perspective of volatility, or would you say it's a misconception of volatility?
Yeah, thank you, Ryan, and thank you, Mr. Manesh. So maybe we start with the main message tonight. Volatility is not the enemy, right? So
Mm-hmm.
volatility is a feature of the market. It's normal, right? The market must move, and sometimes it moves slowly, sometimes it moves violently. That's all volatility is, speed and range. But what people doesn't realize is volatility give you two things at the same time, right?
Okay.
Number one is opportunity, and number two, danger.
Okay.
So actually, it just a same candle. You can make money and you can also lose your money with volatility, right? So when the market is volatile, the biggest change is not the chart. It's not the chart. The biggest change is your emotion, right? Because
Okay.
volatility make you feel like you are missing out. You see pricing moving, you feel you must do something. That is the trap. So I think normal market is like driving on a clear road, and
Okay.
volatility is like you are driving during a heavy rain at night. If you understand what I mean. So it's
Yeah.
just a same car, it's just a same road, but you cannot drive with the same speed. So for me, volatility is just with a simple metaphor, you can understand what is volatility is. So sometimes, and that is the same mistake trader makes every time.
Right?
Yeah, I can hear you. I think
Yeah,
Kaza just went off for a minute.
yeah. So, I mean, while he's coming back, I think
Mistake.
the biggest
Is,
thing is,
is
Kaza, are you there?
pardon? Sorry.
Are you there? Whoa, I think Ryan dropped off.
volatility is not an enemy. It's just the way you understand the market is different, but you just need to to follow the pace of the market, right? Sometimes it's
Yeah.
volatile, sometimes it's slow. So yeah, it's just something like that.
Yeah, I
So
think, yeah, go ahead. I think there's a delay.
I think Kaza is
Ryan,
having
that's
some
from my side.
difficulties, yeah.
Yep.
Yeah, the internet here is like cutting down now. I'm so sorry. I
Oh,
don't know why.
and that's fine. I think it's a normal thing, yeah. Internets aren't supposed to be are not meant to be perfect always, because I mean sometimes
Yeah,
it's worse over
The
here in
podcast.
Africa. Trust me, I
the
promise
internet
you.
here is,
Well,
I don't know why tonight is crazy.
yeah, it happens. But like
So,
you know, people talk about volatility, yeah, and personally for me, I believe volatility is the market. If the market wasn't volatile, we wouldn't be trading it. Because imagine having to stay. I mean, there are some markets that are really terrible. I mean, like really low volatile markets. Let's take, for instance, the Aussie New Zealand dollar is one pair that you could take a 30 pip trade and sit on that trade for 4 days. I mean, you wouldn't get to TP for 4 days. Yeah, and it's like an intraday trade you're just trying to take. You spot a good opportunity, but it just keeps going up and down, up and down, up and like that's a very low volatile market. But now volatility in this instance would be as a result of the presence of liquidity in a certain asset. I'm sure would all agree with me on that. So we
Yes.
yeah.
notice certain assets are more volatile due to the presence of liquidity that's existing in them. Now, the issue that I have is when people talk about volatility, they think of it as just fast movement, not as a result of the presence of sufficient liquidity to actually enable the buying and selling of that pair as fast as possible. So the more liquidity we have on an asset, the presence of people willing to always buy and sell a certain asset brings in more volatility to it. So volatility is just it's a calculation of buyers and sellers present, always active to make transactions. That's just how I see volatility. So
Yeah.
I think people don't have a misconception about it. They just tend to perceive it differently. So
Mm.
some people perceive volatility as during high impact news, fundamental reactions, the reactions of, institutions, buy side, retail traders. Because when we have high impact news, retail traders are very quick to react before institutions come into the market. So institutions literally just buy off their reactions from the market or sell off their reactions from the market. So they see that move as volatility. They see the injection of liquidity by institutions as volatility. So it's all about how they perceive the market that makes their understanding of volatility a reality. Or what do you think, Manesh?
I mean, I completely agree, but I don't think anyone thinks about volatility until they get a volatility spike and they get stopped out, and then it goes in their direction.
That
That's
right?
when the volatility comes into mind with someone,
Yeah.
and it's the first experience with volatility is negative. So from
Hmm.
that point on, they think that everyone's out to go against them. They
Exactly.
start blaming the broker is the problem, and all kinds of things. When basically, if they have noticed the spreads, like for currencies, the spreads were increasing, and that
Yeah.
tells you that the volatility was coming. Maybe a news announcement, something was about to happen, but nope. They get stopped out, and the instant it goes their direction, and boom, oh man, that's volatility. And that's their
Yeah.
first experience, which is negative. And from there, they think that volatility is all negative and everything and starts coming up with excuses.
Yeah. Very, very true. I think my first experience with volatility in the market was when I started trading. I was trading XAUUSD and I had no idea what fundamentals was, but it was NFP Friday. And I
Yeah.
remember having I remember having exactly 75 USD in my account, and I didn't have a stop. So all I knew was I picked up my phone after lunch and I was asking myself that, okay, did I withdraw the money by mistake, or did something happen? Because you know when you open your MetaTrader platform, the first thing you see is your equity bar, and it was just zero. Like the broker didn't even leave, a penny for me. It was just zero. And when I opened the chart, I just saw XAUUSD doing, it just kept going up and down like this. And it was literally on 1 hour candle, just an
Yeah.
hour candle. And it was going up and down. And I was so confused. And when I asked my friend that had introduced me to trading then, it was like, oh, the market was very volatile this Friday. So for a very long time, I thought volatility was just about when the market was moving rapidly. That was a volatile market. But thank God for knowledge, thank God for growth. And over time, I've been able to understand that volatility exists in the market. Sometimes it just increases due to ingestion of liquidity, and sometimes it reduces due to presence of liquidity. That's just what makes a market either more volatile or less volatile. But the market is forever volatile. If it wasn't volatile, we wouldn't have, take profits or stop losses. Yeah, we wouldn't have limit orders being executed and that. But now, when we now move to the point of actually talking about why assets are volatile, we notice that in the currency market especially, or should we say not currency, when we look at the commodities market, they are more volatile than the currency market. I think the most volatile pair in the currency market would be the GBP JPY, GBP USD, and we wouldn't really say the Euro USD is that volatile, but it is most traded and has
Yeah.
a good amount of liquidity. But I notice sometimes when there are certain economic conditions or fundamentals, or we see like in terms of safe haven now, where commodities are thriving, I notice that liquidity kind of shifts from the currency pairs and moves right into commodities. I don't know if I'm the only person who's noticed that. We see a lot of traders move from currencies and try to chase commodities. But why exactly is there a lot more volatile movement on commodities than on currency pairs?
I mean, I think things start varying, right? One,
Yeah.
remember in currencies, you got a decentralized market, right? Whereas commodities is more centralized depending on what you're trading.
Mm-hmm.
But liquidity is the number one answer you gave, right? Also, when you start dealing with commodities, depending on what the commodity is, there's liquidity is the big question. The spreads, margin call, the margin requirements are
Yeah.
bigger for commodities too compared to currencies, so they'll fluctuate a lot. And it varies across the board, but anything that's decentralized, you're going to have a possibility of more, you know, illiquidity and stuff like that. And because there's not one central form controlling it, but liquidity is the number one answer as you gave, Ryan.
So right now on the XAUUSD, yeah, I've also noticed something. I don't know if you would mind sharing a chart on XAUUSD or XAGUSD. I think silver right now is probably the most performing commodity. Probably has even outperformed gold. I know a lot of people are saying like, gold moving, but in terms of returns and in terms of most percentages done, I think XAG, which is silver, has outperformed gold in a certain way. Now, I don't know if you mind sharing your chart, but I just want to say something that I've noticed. As
Do
at
you want
the
me to share
start
it, Ryan?
last, yeah, please feel free to share.
Okay.
Okay.
Is
So
futures fine, or you want me to just do the XAU USD?
yeah, XAG is fine.
You want weekly or daily?
Um, Daily.
Okay.
Yeah. So we see from the first all-time high
There was
when we hit
gold, Manesh.
Sorry.
There was gold.
yeah, that
Uh,
was
we,
gold.
yeah, we want you to open the silver market.
Oh,
XAG.
silver. What's the?
XAG.
XAG.
Sorry.
XAG. X
XAG.
Manesh, you're showing your email right now, not your chart.
Oh, what am I sharing? Okay, share. How about now?
Yes.
Yeah. I can see your chart
Okay.
now.
Sorry, we in the US we do futures, so we're not trading like XAUG and
Yeah.
XFN. Yeah.
So XAG is I think is the ticker for silver.
Yeah.
When it comes to like forex, not futures. Yeah. We see XAG has been bullish since 2024. If you could just pitch in your chart a bit.
Okay.
Yeah. And we see that the returns on the XAG USD is more than that of the XAU USD. But now, when you're trading XAU USD and you're trading XAG USD, the prices of gold seems to be more expensive than silver. But somehow, silver seems to be more liquid and heavier than gold. Is there a reason as to why that is so? Because a lot of retail traders are more conversant with trading gold, but I don't know why XAG seems to be heavier than.
I think I think right now you're seeing more of a move into silver compared to gold, especially from retail perspective because of the price, right? To
Okay.
buy gold now it's 46.17. To buy silver it's 93,
Okay.
right? And margin requirements are different. So a lot of people go forward silver now compared to gold, and they could day trade it a lot more and stuff like that. So it's driving a lot more liquidity now in silver compared to gold.
Mm.
And there's been a big shift doing that too. Um, I'm not sure if we have a little time, but one of the things in the institutional world is we do pairs trading, where you could look at the relationships between the two. And
Okay.
if you look at this is gold versus silver. And
Okay.
you could see here from the charts, and if I keep it to the weekly time frame, you could see here that gold was going up a bigger percentage than silver. And then right around here, April of 25, right here, and you could see this big move here, June of 25, that shifted.
Hmm.
Silver started becoming more dominant than gold. And you could see that from this chart here, because this is a gold versus silver relationship. If this chart's going up, gold is going up faster than silver and vice versa. This is going down, silver has a lot more power. And if you look at this relationship on a long-term basis, you could see that we're trying to go back to here all the way back to 2011. And that's the journey we're going right now, where silver is going a lot stronger than gold, and it's going to continue to do so until you get to this relationship right here, which is around 45. So you're not too far out there, but a lot of this is due to, like I said, the pricing. Because I could hear people in social media right now that are talking about silver, 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 and you ask the question to them why, and they're like, well, I could trade it because it's lower margin requirements. And they think that there's more upside to silver compared to gold, which has been going up for a long time.
Wow.
But I'm not sure if people have seen this relationship where
I
you can map out gold versus silver and you could
I
Yeah.
never
see
I never
the
seen
correlation between.
the relationship between the pair gold and silver. You know, I never
Have
seen
you,
it.
Kaza, did you see how stunned I was? I'm just looking
Yes,
at it, I'm like, this is the first time I'm actually knowing I could actually see the
yeah,
relationship between
and
gold and silver.
basically, if you ask me, Manesh and Ryan, in Malaysia, we doesn't even bother to look at XAG,
Yo,
USD, or
yeah.
silver. We didn't even notice that that pair exists in our MetaTrader 5. Yeah, but for
Yeah, you
me,
can't do that there.
actually, I'm a gold trader since like 10 years ago. I know that I think 5 to 10 years ago, Manesh, that the silver market is not that popular at the time,
Yeah.
and the liquidity is too slow for and even for a broker they doesn't bother to use the pair in the meta traders at the time. But now when you show it to me, and maybe next time I will see the silver market and try to study a bit about that. But the gold market itself, maybe I can say a few words about gold
Yeah.
market. Yeah, it's been rising since early 2024 until
Yeah.
now. Is not going down. The main reason behind that is, this is my personal opinion,
Yeah.
is because of the popularity of this pair. Because I've been living in this industry not longer than Manesh, but this is my 12th year. But if you see it in 2010, 2014, nobody knows about the gold pair. Same like silver pair, right? Nobody's
Yeah.
know about XAUUSD 10 years ago. But it came to popularity, I think 5 to 6 years ago. And suddenly, when I see the market now, the volatility is like a race car. It's just going up, 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 and up. And suddenly, it just take people money or giving
Yeah.
a lot of money to other people. So gold, if you see gold now, the volatility is not as it seemed 5 to 10 years ago. If you zoom out the chart, please zoom out the chart a bit, Manesh. You see the market at that particular date, 2008, 2011 until 2020, the market is probably
Yeah.
the most
The candles are very small. Very.
relaxed, yeah, the most relaxed market at that time. A lot of people making money, a lot of people in a safe zone. But since 2023 and above, people are not realizing that volatility is coming to gold. And you know what, Manesh and Ryan, in Malaysia, I've do a statistic data for the last 3 months. I can say here that 99.99% of gold traders is losing now. Why? Because they understand volatility has a stop. They
Mm.
understand that volatility has a stop. There must be a stop of gold raising up again and again and again. And until today, gold market is going up and up and up, and we don't know where the price will stop, right?
Mm.
So when Manesh talked about silver, I guess that the market will be the same in the next 2 years. How can you agree on that, Manesh? That the market of silver
Yep.
will be the same liquidity as the gold market in the next 1 to 2 years?
Mm.
Yeah, it can be, and it just depends on global event. But I mean, if you could look across the board, you could see platinum here. No one's even talking about this one here. And you could see platinum's moved up, right?
Yeah.
Copper has moved up. So you've seen a huge shift right now across the board. And you see this, especially that started happening June, July of last year. A lot of people shifted towards buying metals.
Yeah.
Yeah.
And and even like copper, if you look at copper here, you have a big volatile bar here, but notice one thing, you just retrace the whole thing here. So June, July, pretty much the summer of last year, you started seeing a shift where a lot of people started buying more metals, and you started seeing a huge shift. That's when silver started overtaking gold a lot more too. And I think it's due to all the global events and also all the countries printing more money. They got to back it up with something.
Yeah.
So you're starting to see this, and institutions start rotating into more of the gold and stuff like that for more of a safe haven. And you're starting to see that there now. But you could see that, silver is being huge going forward. And now where it's moving at a bigger percentage than gold. And that's going to continue to be there because that relationship is distorted now where silver is moving up higher percentage than gold uh, because of the price. You know,
Mm.
the margin requirements for silver is a lot more lower than gold.
Yeah. And this is quite interesting because now that we actually had an opportunity to talk about volatility, yeah, now it's, I believe people on this call, yeah, if you're watching from home, if you're watching from the office, if you're watching while you're on your charts, if you're watching while you're about to trade during the New York session, I hope this just kind of give you an understanding of what really brings volatility into the market. It's not just random. You see, every conversation we've had so far on this call is are some of the things that, ingest liquidity into the market, and that brings about volatility. So liquidity, volatility. Less liquidity, less volatility. More liquidity, more volatility. Liquidity
Yep.
just simply means people want this asset, people want to trade this asset, and that brings the volatility. So if you've been trading an asset for a while and all of a sudden it looks very aggressive, then you know something is changing, and that should bring some level of curiosity to your mind. Thank you so much, Manesh. I feel like I'm going to call you later on because I really want to pick your brain again about this whole, gold and silver thing as well, because it seems to be very interesting to me. But without any
One of
further
the
ado, yeah,
right? One of
yeah,
the
go ahead.
things that institutions do that retail people don't think about is what we
Yeah,
call pairs trading. It's arbitrage. And what you can do is a hedging strategy where if you notice one thing, the two products are very closely related and
yeah.
one product's going up higher than the other one, you could sit there and buy silver and short gold and play the percentages. It's a hedge trade there that a lot of institutions do on a quarterly basis. So, we do that a lot. Is we have tons of pairs where what we call our pairs trading, and gold, silver are one of them. And you could see like here stocks, you could do it on crude oil and stuff like that. And so right now we are long silver and short gold. I know that sounds crazy on being short, but you're just trading the percentage movements and making money off that.
See, this is the difference between retail traders and institutional traders. I hope those watching at home can see the difference. Yeah. So when you go about yapping, talking about, oh, I trade ICT, you're trading it. Yeah, no, you're not. You, you're nowhere close to being an institutional trader. Yeah. But thank you so much, Manesh, for this insight. And thank you so, so much. Like, this is really eye-opening. And I'm definitely going to get back to you on this. But we need to just move, ahead just to keep track of time and make sure people can go back to trade the New York Open. Yeah, so
Yeah.
next thing that we're looking at is why most traders struggle. I think this is where I really want Kaza to come in, Shifu, our mentor. So please, why, aside what is on my screen right now, yeah, I know you have other things, but why do you really think that most traders struggle in volatile markets? Aside, my own suggestions, like to you, what do you think is the core to why they struggle?
Okay. Thank you, Manesh. Thank you, Ryan. First thing first, not a lot of retail traders understand that the volatile market is a fast market,
Hmm.
and a lot of retail traders, they are an emotional traders, right?
Yeah.
And fast market punish this kind of traders.
Okay.
That is not for beginners, it's for everyone. If you lose discipline, you will get punished. Even in a volatile market, even it's just a normal market, you will get punished if you are emotional, right? So in a volatile market, most traders struggle because of three things, like in the slide, right? First is over trading. Volatile market make traders excited because you see, like when we look at XAUUSD, the market is going up and up and up, and we don't know when the market will suddenly fall down. So they get excited. So they want to take every move. But in trading, more trades doesn't mean more profit, right? So more trade usually mean more mistake. So you must understand that volatility doesn't pay you for your effort, it pay you for your position. So as a traders, don't do over trading in a volatile market. Study your market first, look at the market, do your technical analysis, do your support resistant, impulsive corrective pattern, or whatsoever that you learned before this, and don't rush the market. Be relaxed and take position step by step. So that's first. Number two is sometimes a lot of traders, we call it retail traders, they always overrule everything. They think that they are a king of the market. The market will listen to them, right? But if if you start doing things you normally don't do, like maybe you move your stop loss, you cancel your stop loss, you enter early, these kind of things. And the funny part is after you come down, you look back and you say, what did I do, right? Because when you see at the volatile market, it's either gold market or EU or silver market, you you have that emotion that you want to make more money,
Yeah.
right? In Malaysia, like I see a lot of traders, like when they enter a market, right, they already put their SL and TPs in gold market. And when they see the market and they say to themselves, hey, this market can go more, maybe another 1,000 pips. So they will move their SL and they will remove their take profit, right? So suddenly when they remove all that, the things that they usually do maybe before, for sure you will see your account trading will burst out and margin call. Why? Because volatile market is the market that we cannot understand as a traders. You need to understand volatile market as as an investor, right? Because like Manish said, the market movement is uncentralized. It's not like the gold, silver, palladium, even metal. Every metal instrument is not decentralized. It's a safe haven currency, right? So it will move when war happen, when they have a political scenario in the country, when they have they print more money, we call it quantitative easing or QE, right? So this kind of thing, a lot of traders doesn't study. They just focus on technical, right? So that is the second thing is don't change your rule of trading. If you stick with 20 people SL, just stick your 20 people of SL, even the market is volatile, or even you see the market is trending for 1,000 or 2,000 pips. So that's how that is what, in my opinion, how the traders struggle in volatile market. They do not understand the market well in terms of the technical side and in terms of the economic side. So for me, I give you the solution is study both side, right, Manesh? You can agree with me. Not only technical, you must study technical. You must understand the fundamental side, so that when the volatile market happen, you know the what we call it, the sentiment of the market. You know where the sentiment come, and then you follow your rules of trading, and at that time you will not see traders struggle in volatile
Yeah.
market. Maybe I'll be the host. Please manage. Give your opinion on what I say.
No, I think you summed up everything a lot in great detail. This is the only business where it's you against you. Psychology of trading comes into play.
Yeah.
Volatility will break people, because of greed.
Yes.
And that's where it basically happens. And like you said, they'll deviate from their trading plan. My only comment is that, your goal is to take profits when you get to like a 3-to-1 reward risk ratio and to get to break even. At that point, volatility doesn't come into play at all, and you don't lose. So, your trading plan, money management, psychology of trading, everything comes into play uh, in order to deal with volatility.
Yeah.
Yes,
Well,
and maybe a bit more from my side. As a
yeah.
traders, when in a volatile market, the problem is the behavior, not the price of the volatility, right? The
Yeah.
behavior of a traders. That's the main problem every traders already have that they need to remove it from themselves.
Okay. So thank you so much, Kaza. Thank you, Manesh. I was going to add something, yeah. And while you guys were talking, I something just came to mind, and I realized that traders don't struggle in volatile markets. They do, like on a very open surface, they do. But I wouldn't say they struggle. I think they put themselves in positions to suffer. I don't know
Yeah.
if that makes sense. That they actually put themselves in positions to suffer. This is what I mean. So everyone is trying to trade gold right now. And I told someone, I said, I have a rule that works for me. I was talking to a friend earlier on the call. And I said, I don't like to buy highs. I don't
Mm.
care how good an asset is doing. I won't buy highs. Is a rule for me. When I see prices being extremely high, I know very well from understanding market realities is that there's always going to be a trap coming. So
Yes.
what I'm doing is I'm sitting and I'm waiting for the trap. I traded gold in October last year, and everyone was like, "Oh, you were on the buys as well. Were you trading the buys?" I said, "No, I took the sells. I took the shots that happened after we hit 4,500. Those were the shots I took because it's just a rule for me. Because how I came into trading was understanding that we buy lows and we sell highs. So why are you constantly chasing the high? Because I feel like the high is a bubble. You literally just trade in a bubble. It's only moving because a lot of people are wanting to. It takes just 3 phone calls from black institutions to dump the market. That's all it takes, and everyone is out of the market. They literally it's just going to happen like the big shot, and everyone's out of the market. So people actually set themselves up because there's always this, like we say, greed. And aside greed is there's a lack mentality of I need to trade this because everybody is trading it. And since I saw someone making money a couple days ago, I can make money as well. But the truth about it is, since we don't control the market, you never know when you're going to be caught in the crossfire. So last week I gave a short trade idea to my community and I called sells on gold. And my friend came and told me, because my friend is on like multiple channels, and he was like, would I believe that amongst all the channels that he's in, I was the only person that called shots on gold. I said that's because everybody is trying to chase the buys, forgetting that in order for the buys to continue, corrections need to happen as well. So personally for me, I'm seeing the end of gold buys to happen very soon, but nobody is seeing it. And I have my sentiments and I won't give them on this call. But I know the sales on gold are going to come very soon because banks are buying, institutions are investing, retail traders are following. But the truth about it is, institutions never buy things at high prices. They're always looking for the best price. So as much as gold is a safe haven right now, and a lot of hedge funds, a lot of investment brokers are going to be wanting to, buy a lot of gold, safe havens, bars, and all of those things for their clients, they're definitely going to look for a good price. No one is going to come and buy gold at 5,000. It's why you get. So it's what the same thing Kaza is saying is they really need to come from a point where they understand market sentiment, not just technical analysis. Because when you
Yes.
understand the sentiment of the market, buying at a high price is ridiculous to an extent. People are only buying now because they know, if institutions are buying, they're buying because they know they're going to dump it on the retail market. It's
Oh,
just
Ryan, remember one thing. If someone's buying, someone's selling.
Yep.
Someone's
Exactly what you
selling.
said, right? So
Someone
who's
has to
selling?
sell.
If it's so good, who's selling right now?
You get. So who's selling? Someone needs to sell off. It just needs to take the right call, and that's it. So it's the same thing. So like you said, Kaza, behavior, behavior. If you're a trader in the market and you haven't really built like a psychology for yourself. I mean, it was Mark Douglas that described the market as an anarchy, as a chaos. You need to build your own rules
Yep.
around the market in order for you to survive in it. So behavior. What's your behavior to the market? What's your approach to the market? Are you just trading here because you think it's all fun? A lot of
Yeah.
times people just get lost in the market because of the emotional highs and lows. Oh, I'm feeling like I want to go on a vacation, so I want to trade this month. Oh, I didn't trade yesterday, so I want to trade today. They get excited about the market so much that they lose behavior, they go out of character. And
Yeah.
I always tell people, I say, when you want to look at good traders, I like to look at institutional traders. I like to look at people like Manesh, because they're seated in front of their chart and they're not smiling, they're not happy, they're not excited. It's just work. You get, it's just data, it's just statistics to them. But
No,
retail traders, we get
Manas,
excited too early.
it is because Manas doesn't have a feeling.
he lost,
No,
he
no,
lost all his
I
feelings
lost all
30
my
years
feelings.
ago.
Okay. I think I've been whacked so many times to a point now I'm non-emotional and learned to
Yeah,
have
you don't
fun.
feel anything, right, Manesh?
But think about this. This is the only business you wake up and it's different every day. It's challenging and it keeps you awake and keeps you alive. Whereas when I was in the corporate world, it's meeting after meeting, emails after emails, and one requirement after another, and you never enjoy it. This is fun.
It's fun in understanding the fun and still being, in fact, having to wake up in the morning knowing you have to manage your emotions regardless of what has happened at home or what side of the bed you woke up. That alone is challenging. That makes it fun. I mean, for people who really are into, the business of trading and really want to go further with it. But I think we've said more than, and we've given more than enough, things to help people know why they're struggling. So one way to fix it is become disciplined. I think discipline is very is very set out, is very loud, but lessly understood. When people talk about discipline, they think it means you having to become very rigid, very tough. It means that you have to become a shifu, you have to become, you have to become some kind of sensei master kind of thing. But really is being disciplined is just the little actions you take every day that makes you become a better person. That's just what being disciplined is. So if it means I don't look at the charts every day, I used to be that person. I mean, in your learning phase, it's important for you to study a lot. It's important for you to build your mental faculty and your eyes to be able to recognize patterns as fast as possible. We're in a game of patterns, we're in a game of numbers, we're in a game of data, we're in a game of statistics. Yeah. So you need to recognize patterns. But over time, you realize that once you've been able to know, you've been able to study, when you look at charts too much, you get cloudy. Your judgment becomes very cloudy because now you're trying to over process, you're trying to over analyze, and that becomes a problem. So being disciplined is not we saying stay on the chart every day. You have to be on the chart if you're a trader, you have to do this. No, we're saying have rules that keep you grounded. At the end of the day, you need to have rules to keep you grounded. Oh, I look at my charts Sunday night. I look at my chart on Wednesday. I look at the charts when I know the market is about to become more volatile. I look at when we have fundamentals. Things like that should guide you. So at the end of the day, being disciplined is having some level of guidance in the market. And that is the overall rule to making sure you don't struggle in volatile markets. Like Kaza said, know the volatile market, understand why the market is volatile, stick to your rule. If the market is too volatile and it doesn't sit to your trading rule or your trading pattern, sit out. Just take a break,
Take a
relax.
break, drink a coffee or do whatever it takes. Just not look at the meta traders or your chart. Just don't.
My mentor always told me every hour you need to take a 5 minute break, at
Yeah.
least 5 to
Even if
ten
you're
minutes.
If you don't even want to day trade, if, for instance, if gold is the only thing you trade, yeah, except if you probably haven't made enough profits. But I mean, the idea of making profit is profits are supposed to build up. They're supposed to be able to sustain you for a long time. And I always tell people, yeah, get another thing to do, get a side hustle, get a job by the side until you've built enough, wealth or enough money to be able to sustain you on the days where you're not going to be able to trade. With how aggressive gold is right now, if I was a gold trader and it was too aggressive for me to trade right now with my capital or anything, I honestly would sit out, go spend time with family, you know,
Yes,
spend time with your girlfriend, read a book,
if
do
you have
something.
one.
Yeah, if you have one, like Tata doesn't have one. So you get do something. You don't have to trade the market if it's not favorable to you. Personally, for me, I built a habit. If market conditions don't sit with my present behavior, I'm not trading the market. If I know I'm going to be busy for, if I'm going to be busy this week, I don't have to look at the market because I'm only going to be setting myself up to fail. Because if
Yes,
I'm busy, I won't have time to look at the charts. If I have to be using my brain to operate on different things, then I would take a trade and completely forget that I actually took a trade. So I look at my behavior, then I look at the market behavior, and then I say, is this in alignment? Can I work with this? If I can't work with this, I'm not trading. Yes, I might be losing out money, but that's why it's the market. There's always going to be opportunities for you to make as much as you want to. You just need to be able to scout, plan, and execute. So, guys, please, if you're still watching the live up to now, please don't forget to like, subscribe, follow our YouTube channel at Valetax, and also like and follow the Facebook page at Valetax Official. Okay. Thank you guys. Very soon I'm hoping that we would start streaming on Instagram for our Instagram buddies. So you would be able to connect on different platforms, TikTok, Instagram, YouTube, and Facebook as well. Thank you guys so much for watching. So we're just going to try and round up as quick as we can so we meet up with timing. How to achieve steady growth. I've been able to put up some things here, and I'll just let my guest just elaborate a few things for us. So I said how steady growth is achieved. Growth comes from control, no excitement. Like I stated clearly about Manesh, you don't see him being excited. I'm very sure Manesh is on a trade right now, but he's not happy. He's not doing all of that. He's just calm and he's in control. He's looking at his chart. He knows where his parameters are. He knows where he's looking for his next entry, and he's just chilled. You get so it's not about excitement. Some people get in profits and they're so excited, and it's one of the reasons why they never let their winners run and they let their losers run. It's excitement and fear. Yeah. So the moment you can control those two emotions, you're good to go. So I said reduce position sizing. I think I have a reel that was put out last week where I talk about why people lose. It's not necessarily because of stop losses, or you find people trying to use very tight stop losses and they think that is risk management. And I'm going to still say it on this live. Small stop losses is not risk management. Risk management is in position sizing. I think people need to understand this. Risk management is not in you trying to force a small stop loss. I think a lot of trading methodologies have taught people to use tight stop losses. I see people trading other blocks in retail and they're using 5 pip, 10 pip stop loss. And I'm like, you need to let the market have room to breathe. You don't control prices. Prices could find liquidity at any level that it wants to sweep or something. Most important is your position sizing. I've seen people trade without stop losses and still never went bankrupt. It's all about position sizing. You need to understand what you're doing, yeah? And then I said trade fewer and clearer setups. Stop trying to trade too many things at the same time. Stop trying to take every trade setup you see. Does it meet your trading style? How do you want to trade that particular setup? Is there an entry requirement? If it's not, give yourself like certain ticks, what do we call this thing? Check boxes, yeah, to know if that trade setup is an 80%, if it's a 50%, if it's 60, if it's 90. Depending on the percentage and the mark it meets, then you know how to manage your risk towards it. I mean, you could see a 60% setup and it would still play out fine. The difference is how you risk on that. So if I usually would risk 3% on a 60% setup, I'll probably go 1%. So that helps you manage, and that I think that's the smart thing to do. I feel like I'm starting to explain this thing to them. Yeah, Manesh. It's like the smart thing to do. You don't risk the same size every time. Respect higher time frames and accept sitting out as a strategy. We've all said these things already. Or don't you think so, Kaza?
Yeah. For me, I see steady growth in a different way, Ryan,
Okay.
Manish.
Okay.
I I don't see if you reduce your position size or trade fewer will you will have a steady growth. For me, if you want to have a steady growth, you must be selective of the pair that you want to trade, selective of your time that you want to trade, and then it came to the next step of selective on the position size that you want to put, right?
Yeah.
Because if you are in a volatile market or even in a normal market, price is moving everywhere. It's look it's look like an opportunity every minute, right? So you
Mhm.
open the chart and feel like if I don't enter now, I'll be losing money. Or if
True.
I don't know the correct word is FOMO, right? Fear of missing out.
Yeah. Fear of missing out.
So a lot of traders have these FOMO ideas.
Mindset.
So
Yeah.
they're afraid of losing, or they're afraid of losing the position. They're afraid of. That's why a lot of traders always say to me, why am I have the courage to hold 100 pip of losses, but I do not have a courage to hold 100 pip of profit?
Profit.
Why
Yeah.
is that? Is it because you are not trusting yourself, you are not trusting your analysis, so the noise is everywhere in your mind, so you will not have an what we call it, a good mentality to study the behavior of the market. So if you ask me how steady growth was achieved, I will, like I said, I will be more selective. So I will I will train myself to slow down mentally even when the market is moving fast. You know,
Yeah.
human mind psychologically, if everything is going fast, you tend to follow it, right?
And to,
But for
true.
me, I don't want to do that, and I hope the audience that are listening now don't do that. If the market is going fast, you just follow your pace, right? If you're thinking that your pace is 2 or 3, just follow that pace. It's like a marathon. If you are just a newbie in a marathon, don't follow the professional marathon runner, right? So you just
Yeah.
follow your pace. So if you ask me, I just train yourself to slow down mentally so that um, i- to remind yourself not every movement is a setup.
So no.
So most of it sometimes is a noise, sometimes it's a fake momentum, sometimes it's just a liquidity grab, right?
Yeah.
So the market will spike up, then spike down, spike up again. So if you chase every candle, you are not trading, so you are reacting. You understand what I mean, right? Sometimes people are following the market, but they think I'm a trader, I'm trading now, but you are reacting. Your emotion is beyond your understanding of trading. So for this topic, I guess I go in short: be more selective, slow down your mental, not follow the pace of the market, but follow the pace of yourself. Because at the end of the day, the market will still going without waiting for you, but you
Yeah.
can still chase the market slowly because
Yeah.
the market will not stop, right? And we still have the government, we still have currency. So in the meantime, you need to understand that trading is still there. So just relax and follow your pace. Like Ryan said, if he is busy, he will not look at the trade, or if he doing the trade, he just sell and forget, right? So that is the pace that we want. Because if you have the FOMO mindset, trust me, everyone, you will not become a trader. You just become a gambler for me. So yeah, that's my opinion on the topic. So please.
I have so enjoyed this topic that I completely have lost track of time. I think we've gone over an hour. Yeah, but Mahesh, please feel free to just
Please
put in
manage.
Now,
one or
I'll
two.
just summarize it. So your trading plan consists of two components, the money
Yeah,
management and the technical and the fundamental. From the
yeah,
technical, your research and everything will tell you what type of trades you're taking. And if you
yeah,
do the research correctly, you'll realize that you respect higher time frames, quality over quantity for number of
Yeah.
trades and everything. And then your money management will control your risk per trade. You should not be, your position size should be based on the risk per trade, whether it be a dollar amount or percentage of your account. So
yeah.
all that will control it there. I'm a firm believer of 90-10, 90% research, 10% trading. And that's where you really should be concentrating on to become a professional trader. Because if you did your research and everything, you'll be confident to trade it with no issues, no psychology of trading, nothing going forward. Of course, you're human, so you will have that. But if you did your research and you saw that your system works in the past, then there's high probability it's going to work in the future as long as you don't interfere with that trade.
Thank you very much. Like you said, you really were going to summarize it, and you just did that. Yeah. So I'm just going to run through like towards the end of the 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 PowerPoint that I have on. Yeah. So we did this last week, and I'm just trying to keep this as a habit for us in January. Yeah. So this is 2026, and there are a lot of things that we need to do differently for our audience watching far and wide. 2026 demands structure. Like, let's leave the bad habits that we had in 2024 and 2025. There's a new year, yeah, and it's not about new year, new you kind of thing. No, it's more about new year, new mentality. It's not new you. Leave you alone. Focus on your mind first, yeah. Ask yourself, what will you stop doing? What are you supposed to refine and not replace? Sometimes it's not about replacing things. Sometimes it's you already have it right. You're just too distracted to implement it properly. Yeah. So how do you refine that? Then number three is, what rule will you never break again? Because we've set a lot of rules. I personally have set a lot of rules that I've broken. But maturity is realizing that you can't keep breaking rules that are supposed to protect you. That's just you putting yourself in harm's way. And only a fool, even the Bible describes, is going to want to put himself in harm's way. So it is important and it is profitable for you to direct your wisdom. So sometimes you have the wisdom, you have the knowledge, you just don't know how to direct it. So please focus on how to direct that knowledge you have. Everything you have, know how to direct it and implement it and use it. Okay. Execution is what makes you a trader, but foolishly executing makes you a gambler. You get it. So if you're just going to keep executing, you're just gambling. But executing properly makes you a better trader. Okay. So that being said, here are three takeaways that I want to leave us with today. Volatility rewards patience, not speed. If you're patient enough, volatility in the market is going to reward you. Like Manesh said from the start of the call, we don't get to our take profit region without volatility. You wouldn't have all the results you have today without volatility, because there was no volatility in the market. You could as well just have been sat in 100 pips position from the start of 2025 to the end. Okay. Risk adjustment is a professional skill. I need people to understand this. As much as we say have a rule that you flow by, there's also a need for flexibility when it comes to you being a trader. You need to be able to spot and identify that something is wrong here and adjust your risk immediately. It's a skill. Yeah, even institutions do it. They know when to reduce and cut down their risk and all of those things. Consistency beats aggression every time. You can be aggressive, okay, once in a while. I wouldn't lie. Every trader has been aggressive. Even Manesh has times where he's aggressive. Kaza has times where he's aggressive. But the most important thing is it doesn't stray them away from their consistency. Good traders have a risk portfolio and they have a consistent portfolio. a growth portfolio and a risk portfolio. On your risk portfolio, you can be aggressive with it, but not just being aggressive foolishly, but being aggressive even in rules. Okay, there are times where we would want to risk 25% of an account, but there's a rule that guides it. Yeah, we don't just jump and risk 25% of any account. That doesn't make sense. So stay consistent every time, and you would gradually see how you have that steady growth is all about consistency, not being cold today, being hot tomorrow. It's being able to maintain a warm nature all through and let that ladder ride. So thank you guys so much for watching far and wide. YouTube, Facebook. Don't forget to like, subscribe, and turn on post notifications so you'd be alerted on when the next episode is going to be hosting, and you'll also be alerted at the start of the episode so you can tune in to watch. And to my guests, thank you so much for being a guest on ValeTalks. Thank you for always being company to me, because I can't imagine only myself having to go through all this knowledge. Yeah, it's always wonderful to have Kaza and have Manesh. I believe in coming episodes we're going to have more guests. We're going to have other traders, from different regions, our partners at Valetax as well. And we hope to, engage in more exciting discussions. And like I said, please don't forget to like and subscribe. Don't forget to like and follow on Facebook. And we'll see you guys on the next episode. But before I leave, Kaza, Manesh, is there, just a little nugget you want to leave for our audience, and then we call it a day?
Have fun. Make volatility your friend.
Okay, then. So have fun, guys, and let volatility be your friend. And until next time, we'll see you on ValeTalks by Valetax. And I remain Ryan for a reason, guys.
Bye bye.
Bye, guys.